Good evening and welcome to Geopol Strat, the online magazine dedicated to in-depth analysis of global economic and financial geopolitics. I'm Manuela, your host, and tonight we're devoting a special edition to an event that is upending the international order. The capture of Nicolas Maduro by U.S. forces on January 3, 2026, during a daring military operation in Caracas. Maduro and his wife Celia Flores were transferred to New York, where they pleaded not guilty to charges of narco-terrorism and drug trafficking. Delcy Rodriguez, the former vice president, has been sworn in as interim president, while President Trump stated that the United States would manage Venezuela during a transition period. This act, described as a kidnapping by Caracas and condemned by much of the international community, has massive economic repercussions for Venezuela, China, and global markets. The Venezuelan economy already bled dry after years of crisis, GDP contraction of over 75% since 2013, hyperinflation, U.S. sanctions, is now plunged into unprecedented chaos. PDVSA, the state oil company, has seen its production drop sharply. Shutdowns in several fields, frozen exports. Oil accounts for 95% of the country's export revenues. Markets reacted violently. Venezuelan bonds saw yields explode, the Caracas Stock Exchange plunged, and the Bolivar risks accelerated devaluation. But let's look at the longer-term outlook. If a U.S.-backed transition succeeds, sanctions could be lifted quickly. This would open the door to a massive return of U.S. oil companies. Chevron and ExxonMobil could restart production in the Orinoco Belt. Experts estimate a possible GDP rebound of 10 to 20% per year if oil flows normalize. Foreign investment of $20 to $30 billion could flow in over 5 years. Now let's turn to the impact on China, which has been Maduro's main economic lifeline. Since 2007, Beijing has lent more than $60 billion to Venezuela, mostly in the form of loans for oil deals. China imported up to 500,000 barrels per day. With Maduro captured and a possible pro-U.S. shift, these agreements are threatened. An interim or transitional government could redirect exports to the United States, reducing China's share by 20 to 30%. For the Chinese economy, the consequences are primarily financial. Caracas still owes Beijing around $20 billion. A default or forced renegotiation could lead to massive write-offs for state banks, like the China Development Bank, increasing non-performing loans at a time when Chinese growth is already projected around 4.5% in 2026. Chinese companies, like CNPC, have invested billions in joint ventures. Seizures or operational shutdowns could cause losses exceeding $5 billion. Overall, this event reshuffles the global energy deck. Oil prices have already risen 5 to 10% since January 3rd, with fears of prolonged disruptions. Emerging markets are watching anxiously. Who will be next? For Venezuela, it's a high-stakes gamble between economic renaissance and prolonged chaos. For China, a lesson on the vulnerabilities of its Belt and Road strategy. Thank you for joining us on Geopol Strat. Good night.